Circular 230, gotta love it. This is going to be a lot of points on the exam. It's something that, you'd say some of these things are intuitive and you'd think they're common sense. But the thing is, with rules and regulations, yeah, a lot of it is common sense. You just have to write it out and put it in documentation, because if it's not in documentation, it's not an official rule. I'm not saying this is going to be easy. It is just a lot to memorize and know here, and we'll go through it. But this is a little bit more light. We're not dealing with calculations or anything. Now, Circular 230, this is a document that was published by the IRS that outlines the ethical and professional standards for individuals who practice before the IRS. So this is important because, let's tie it all together. If you're considered a tax return preparer, you have to follow Circular 230, simply put. And that's why it's very important to determine who is a tax return preparer. Now, specifically, Circular 230, this applies to certified public accountants and other tax professionals. So yes, CPAs for sure, but also other professionals. So if you're an enrolled agent or an attorney, someone like that, Circular 230 sets forth rules and regulations governing the practice of tax professionals before the IRS. It's going to outline ethical and professional standards that these professionals must adhere to in order to maintain their good standing with the IRS. And don't you know it, we do want to maintain good standing with the IRS. Don't ever cross the IRS. Not that I have, but can't imagine it's a fun time. Just ask Al Capone. Now we've got the subparts of Circular 230. This is, just think of it like a big old document with a lot of rules that we have to become familiar with. That's all it is. Rules that you have to follow. And we're going to see A through E. Each have varying importance. We'll talk about that as we visit each one. Let's dive in and see what we got. All right, diving into Circular 230 here. CPAs are going to be subject to Circular 230 if they practice before the IRS. So yeah, if you do that, you've got to follow all these rules. This is going to include preparing and filing tax returns, representing clients in audits, and advising clients on tax-related matters. Now, anyone, CPA or other practitioners such as attorneys or enrolled agents, they may be subject to disciplinary action. That's not good. Sanctions, fine, or disbarment. That's, again, not very good. You don't want to see that. Now, some provisions we're going to see deal with conflicts of interest, duty to exercise due diligence. We got some other things here, and these are the more important ones that we'll talk about. And then lastly, CPAs have to complete CPE courses. That's something we kind of mentioned throughout. In order to maintain their compliance with Circular 230, you want to make sure that CPAs remain up to date with taxes, law changes, and anything ethical standard related. It's a great way to make sure that, yeah, even though we're out of school, they're still going to make us take school classes, right? Moving on to the next one. Now, Subpart A, authority to practice. You don't have to memorize these topics within, this is in Subpart A. These are just items to know, and it's broken out organically just because why not? But again, it's not like you need to know that all of this stuff is within A, you just need to know it. Now, Subpart A, this is going to deal with who can practice before the IRS and under what circumstances. Here are all of the individuals. Now, we did kind of mention some of these before as it was relevant, but here's a comprehensive list. I mean, I'm sure there's more, but this is what you need to know for the exam. There's always more in real life, right? Attorneys, and there's not much more in-depth items that we have in these, so I'm just going to kind of breeze through them a little bit more quickly. We've got attorneys and CPAs, enrolled agents. These, as mentioned, kind of like you got a certain amount of requirements that you got to pass some tests. If you're an enrolled agent, I'd love to hear how it went for you. Just not too sure myself. Enrolled actuaries. Actuaries are those individuals who are incredibly intelligent at math. You may hear about them working for insurance companies, calculating what the likelihood of someone living to a certain age is based on all of their factors, and then determining what they should pay for insurance. So too do these people work in the tax world, and they deal with lots of super critical thinking based calculations. So that's something you would definitely see as well. Enrolled retirement plan agents. These are individuals who work specifically for retirement planners. And lastly, we have registered tax preparers. This is just a catch-all. Anyone with a PTIN, right? Anyone with a PTIN, anyone's completed the annual filing season program with the IRS. They're authorized to prepare tax returns and provide limited representation before the IRS. That's about it. Make sure you're familiar generally with who can practice before the IRS. Subpart B. These are the duties and restrictions relating to practice. Start off withholding privileged information. So don't do that. Don't withhold privileged information from your client, but you want to make sure that you're not sharing that with any other party. So practitioners may withhold information if they believe in good faith that the information is privileged. However, if they do not possess the information, but they know who does, they must inform the IRS. So the IRS asks you a question, and you got to obey the IRS, whatever they say. That's standard rule. In a lot of situations, they'll be like, what do you do? Well, just listen to whatever the IRS is saying. That's honestly what you'll see in a lot of questions. However, if they're asking you how much, did this person really have deductions? Say, I don't know, but this person's attorney does. Well, that's in one case, you can breach confidentiality for the client and tell the IRS agent what you know, is that you should go talk to the attorney. Client omission. Well, in cases of client non-compliance or omission, the practitioner must notify the client either orally or in writing about the non-compliance and the potential legal consequences. So if you know your client is doing something illegal or just irrational, not in good faith tax-wise, it's your duty to tell the client, hey, if you overstate this deduction, the IRS can come after you, they can sue you, they can audit you. Due diligence. Practitioners must exercise due diligence, do your homework, do your research in preparing, approving, and filing tax returns and other documents. They also have to ensure the correctness of any information provided by them to clients or the Treasury Department. Practitioners should also avoid causing any unreasonable delays in their dealings with clients in the IRS. We'll see examples where, you may be at fault if you cause unreasonable delays, if you take on too much work and you can't get people's tax returns to them on time. That's critically important. This is a very time-sensitive nature of an industry, and guess what? You may have heard of busy season. Well, there you go. Assistance. Tax practitioners must not provide or receive assistance from anyone who has been suspended from practicing before the IRS. Just don't associate with anyone who's got a bad reputation there. Also, a big one here, they also cannot accept help from any former government employee if doing so would violate Circular 230. So you can't get help from an IRS agent who might be able to tell you what you can get away with and what you can't, because the IRS agent might be able to tell you, oh yeah, the IRS doesn't actually investigate this kind of deduction, so you can totally take that. That would be a big no-no, as well as any other government employee in general that could help you get around or do things that you shouldn't be able to, kind of like insider trading. You can think of it like that. Lastly, conflicts involving former government employees. This is kind of building on point 5. If a former government employee works at a firm and creates a conflict of interest, the firm must isolate that individual. Sorry, but you're getting locked in solitary confinement. Additionally, the former employee cannot represent or assist parties they were personally or substantially involved with during their government service. This sounds similar to our audit rules where partners have a rotation period. There's also a 2-year prohibition on representing parties for whom the employee had official responsibilities, and a 1-year prohibition on appearing before the Treasury Department regarding rules they participated in developing. Generally speaking, if you worked on something, you can't go to the private sector and start working on it there. You got to give, especially its privilege information, specific complexities such as taxes, important stuff like this you can't mess with. Some more items here. We've got our duties and restrictions. Now, notary restrictions, a lot of these are just multiple choice questions. Tax practitioners cannot act as a notary for any public documents related to matter which they're representing. A notary is someone who formally, essentially stamps a document and says, I recognize this, I'm putting my word behind it. You may have had to do this for your CPA application, something like that, get it notarized. Fees. Tax practitioners cannot charge unconscionable fees. Contingent fees are only allowed under specific circumstances. So you can't gouge your clients. You can't charge them $10,000 for a simple individual return. That's not allowed. That's called just committing a wrongdoing. Contingent fees, meaning you tell the client, hey, the fee here will be 10% of whatever money I get for you. That's a contingent fee. These are only allowed under specific circumstances, such as an IRS examination, challenge to original tax returns, refund of interest or penalties, and judicial proceedings. Contingent fees, this is very much a conflict of interest issue, more specifically for when you deal with an audit. An audit, you're supposed to be independent, and you can't really be independent if you get a percentage of the fee that your client's going to receive in their funds. Returning client records. Well, practitioners must return client records upon request. The tax return is the property of the taxpayer. Now, your work papers are property of you as the tax preparer, but making sure we understand who owns what. Although some states may allow them to withhold records in a case of a fee dispute, that's something to know in a few cases. Yeah, that might be an answer to a question, is that you can withhold the tax return if you're arguing with the client about if they didn't pay you enough or something like that. However, clients must still be granted access to review or copy records, and it doesn't apply to the work papers because you own your own work papers. What about solicitation? Well, practitioners must not use false or misleading information in their advertising or solicitations. You can't guarantee a certain outcome. You can't guarantee that you will get someone a $10,000 refund. You can't guarantee that you're going to get them the lowest amount of tax out of anyone they know. You can't guarantee anything like that. That's false and misleading. Also, the IRS is not a fan of that, as you can imagine. They cannot guarantee specific outcomes, such as reducing or eliminating taxes. Written fee schedules must be honored for 30 days from publication, meaning if you advertise that you're going to charge $1,000 for every individual return, you have to honor that for every 30 days, kind of like advertising law. So not that we dive into that really in the exam, but we're talking about soliciting business and advertising your businesses as a tax preparer. Solicitations via radio, television, or direct mail must be retained as per specific guidelines. Best practices for all of this. Well, tax practitioners should follow best practices in their dealings with clients, including clear communication of engagement terms, diligent fact-finding and analysis, advising clients on the importance of conclusions reached, acting fairly and with integrity, and also ensuring that employees follow these practices. If it's a big firm, we got a lot of employees. Lastly here, competency, just be competent, right? Just do your job well, if it was so easy. Tax professionals must be competent to practice before the IRS, possessing the necessary knowledge, skills, and experience to provide accurate and ethical tax advice and representation. So if you're not up to the job, you shouldn't be doing the job, essentially. All right, running through client records, important topic here for sure. Understanding what the client records are. If any of you have worked in the real world and accounting firm, this is what we would call PBCs, whether you're in tax or audit. You've got client records. Now, these generally refer to any documents or materials that are provided to a tax practitioner by a client or on the client's behalf, which the practitioner relies on to perform their services. Client records can include all of the following. And first off, yes, it's important to understand what a client record is because there are special rules around them. Also, this is something you could see as an exhibit. You're preparing someone's 1040 for a SIM, and all of these could be exhibits. So first off, just general familiarity. It's a great thing, right? Making sure we understand all of these topics, all of these items, where they would fall if you were to see them in a SIM. Now here, first off, we got materials prepared by a client's actuary and provided to the practitioner with respect to tax preparation. Maybe this is not your classic, just has a W-2 job and that's it. Let's say you've got a client, they have a lot going on. They've got multiple properties, they've got annuities, they've got side businesses, and that client may have an actuary for some of those estimates. These materials could consist of actuarial calculations, reports, or analyses that help the practitioner determine the client's tax liability, deductions, or credits. I mean, this is anything. This would be if the client's lawyer gives you some documentation, if the client's best friend who did some work for them, whatever it is, anything given to you by the client, even if it was provided by someone else initially, these are the materials that will go into that tax return. Written records given to the practitioner at the beginning of the engagement, nice catch-all. These records may include financial statements, tax returns from previous years, contracts, agreements, invoices, receipts, or any other documents that the client provides to help the practitioner understand the client's financial situation and tax obligations. Next up, electronic materials provided to the practitioner that existed before the client retained the practitioner. So it doesn't matter if this existed before you as the tax preparer came into the picture. If it's the client's property, it is a client record. These materials can include digital versions of financial statements, tax returns, spreadsheets, or any other electronic documents that the client shares with the practitioner. Next up, bank statements and canceled checks. Obviously, this could be incredibly helpful for preparing tax returns. All those financial records. These records can help the practitioner verify the client's income, expenses, and other financial transactions, which may be relevant for tax preparation or planning purposes. Next up, payroll records. Now, whether this is the client receiving it because they work for someone, such as a W-2, or maybe the client has a business where they have to pay employees, it could be from either side. This information, including W-2 forms, can be essential for determining the client's employment income, Social Security, and Medicare tax liabilities, as well as for preparing individual or business tax returns. And lastly here, I mean, this is not all-encompassing. We will continue to go through other examples as well. But even with all those other examples, I mean, anything could be a client record. Again, these are just mostly the most common ones you'll see in the exam, and also items that tie into other lessons as well. 1099 forms. These forms report various types of income, such as interest, dividends, or non-employee compensation. I mean, these are very commonly exhibits for simulations, so make sure you know how to navigate those that the clients received during the tax year. Tax practitioners use these forms to help determine the client's taxable income. And just like with the W-2, just like with 1099s, you should know where that goes on a 1040, because guess what? You could see a 1040 as a SIM, and that would be essential to know so you get as many points as possible. All right, as promised, we got more examples. But again, I mean, we could go on and on. Like anything can be client records. And then again, why is this important? First off, because any of these can be exhibits that you'll see when preparing a 1040 or other various SIMs or forms, as well as just understanding these, memorizing them. And there are various implications for these and how you can use them, the fact that you have to return them to the client, all of that. So property records, documents such as deeds, property tax bills, right? Property tax could be an itemized deduction, or mortgage statements can provide information about the client's real estate holdings, which may be relevant for calculating property taxes. Gotta love property taxes. Deductions for mortgage interest or depreciation for rental properties. So we see why these can be absolutely important. Retirement account statements or investment account statements, very similar here. This is just an investment account meant for retirement, whereas this is a normal taxable investment account. Records related to IRAs, 401k plans, or other retirement plans can help practitioners determine the client's retirement contributions, withdrawals, and any associated tax implications. Like I mentioned, a lot of these we will see pop up in other lessons and how they apply to individual income tax preparation. We'll see how that all ties together. Investment account statements. These statements can provide details on capital gains, losses, dividends, and interest income from the client's investment portfolio, which are necessary for determining the client's tax liability. Next up, business records. For clients who own businesses, additional records such as financial statements, general ledgers, invoices, and expense receipts may be necessary for the practitioner to prepare business tax returns. Because if you are an individual, maybe you're going to the tax preparer with, let's say, a side business, a Schedule C, a sole proprietorship. Maybe you've got an actual business where you've got a legally formed corporation. So as an individual, you could be going with all of these, and that's how we'll see throughout this exam that everything ties together. You could have a corporation and then you could have distributions from that corporation, seeing how those distributions affect your individual return. Oh boy, lots of stuff, but we'll prepare you well. But just again, as a general reminder, this exam, you have to have every lesson on your mind at all times. It's absolutely wild. Advising on business related tax matters. So we'll see how that all plays into account. Charitable contribution documentation. So whether it's the corporation that the client may have or if it's their own charitable contributions, these can be itemized. These can be deductions there. So clients may provide records of their charitable donations, such as receipts, acknowledgement letters, or bank statements to substantiate deductions claimed for charitable contributions. And then we've got records related to tax credits or deductions. Clients might provide documentation to support various tax credits or deductions, such as childcare expenses, education expenses, medical expenses, or energy efficient home improvements. And we'll dive into that. We've got a whole lesson on tax credits. All right, we've got another one, Subpart B. We're going through and dealing with standards for our tax preparation. Subpart B deals with standards with respect to tax returns and documentations. Tax practitioners must follow these guidelines to ensure compliance with professional and ethical standards. Now, the non-frivolous positions. Now, we see that a tax practitioner cannot advise a client to take a position on a tax return unless there's a reasonable basis for that position and it's not frivolous. You can't say, take this deduction because it'll save you a lot of money. Maybe it will save you a lot of money, but if you're not legitimately able to be eligible for that deduction, then obviously we should not advise clients to do so. A frivolous position is one that has no merit or is taken solely for the purpose of delaying or obstructing tax payments. We'll see the various classifications for positions to take on a tax return, but just getting familiar with these terminologies. Next, compliance with rules and regulations. Tax practitioners cannot intentionally disregard any rule or regulation when preparing or advising on tax returns. Got to follow those rules. However, if the practitioner believes in good faith that they can challenge the rule or regulation, they may do so provided that they have a reasonable basis for their position. It's wild. When I started in tax, I thought it'd be black and white. Oh, you owe taxes, you don't owe taxes. Here are the credits, here are the income items. But it is so gray. It's absolutely incredible whether you are at a higher level of dealing with private equity hedge funds, arguing with the IRS, taking tax positions, or you're an individual. Obviously, probably not a simple situation, but let's say you're someone with multiple businesses, and it's incredibly wild how gray the tax code is and how much arguing you can do against the IRS. But if you have a good faith position. Next up, advising on penalties. Tax practitioners must advise their clients on any penalties that are reasonably likely to apply to their tax situation. This helps to ensure that clients are aware of potential consequences and can make informed decisions about their tax positions. Even if you have good faith and you believe that this client is eligible for a credit or a deduction and they take it, it is your job as the tax practitioner to say, hey, yes, I do believe in good faith, and I'm using all of my goodwill here as a tax practitioner, that you are eligible for this. Here's the penalty if you are not actually eligible and the IRS catches you and they say you're not eligible. Now, obviously, you're still doing your job. It's weighing risk and reward, but that's just part of the job. It's part of the duty. Next up, reliance on client information. In general, tax practitioners can rely on the information provided by their clients when preparing tax returns, unless the information appears to be incomplete, inconsistent, or incorrect. Great example is if you're doing someone's tax returns every single year, and all of a sudden 1 year they've got no income and they've got a crazy amount of deductions. That would be a red flag. Now, if you talk to them and you find out and you validate, oh yeah, this person was laid off, and you understand where all of these changes came from, that's one thing. But that's just a great example where you can take what they say at face value, and it's not your job to fully audit them, but try to get an understanding as to where all this activity or lack of activity came from. In such cases, the tax practitioner should make further inquiries or seek additional documentation to clarify the information before proceeding with the tax return preparation. It's just, how much work should you do? Well, if the tax return gets audited, if you get under fire as the practitioner from the IRS, if you can prove that you did enough work, it's not your job to fully do all the work for this one client. You've obviously got other clients, you've got other things going on. But if you prove that you've done enough work to try to validate this, then you'll be fine. All right, written advice. Let's talk about Subpart B written advice. Now, this is written advice given to a client. You are the tax practitioner giving advice to your client. First off, advice must be reasonable and supported by facts and laws. The written advice must be based on reasonable factual and legal assumptions. You can't just spew out whatever you want. This means that the tax practitioner must ensure that the advice is grounded in a proper understanding of the client situation and the relevant tax laws. Again, also, it's important. Everyone's tax position is different, and you need to take that into account when giving someone advice. Now, in general, written advice does include electronic communications, change with the times, right? This will include emails or phone calls or anything like that. This is anything. It doesn't have to be on a letter sent over pigeon mail to the client. Next up, consideration of all relevant facts. The tax practitioner must consider all relevant facts when providing written advice. This means that they cannot cherry pick facts that support a particular position while ignoring other important information. Now, you got to take into account their entire situation at all times as you're going through it. You can't just, hey, your side business, let's do this here, without considering the impact that may have on, let's say, their investments, their personal investments. Next up, reasonable reliance on representation. Tax practitioners should not rely on representations from the client or other parties if such reliance would be unreasonable, kind of what we saw on the previous slide. This requires the practitioner to exercise professional judgment, something huge in audit as well, in determining whether the information provided is reliable. No consideration of audit likelihood. The practitioner cannot take into account the possibility that the tax return may not be audited when providing written advice. That's a big one right there. You can't say, oh, let's take this position because I know with my experience, clients generally don't get audited if you take this deduction. That's super no bueno. You're not going to do that. That's against everything here with the IRS. This ensures that the advice is based on a correct interpretation of the tax laws rather than the chances of an audit. Next up, good faith reliance on advice from others. Tax practitioners can rely on advice from others as long as it is reliance in good faith. This means that the practitioner must have a reasonable belief that the advice provided by others is accurate and reliable. You can't go to a happy hour and meet up with a lawyer who drunkenly gives you advice on what you should do, tax-wise. Maybe you can take that and revisit with that lawyer the next day when the lawyer's sober and validate what that lawyer said. But you need to have reasonable belief that whatever advice you get is accurate and reliable. Next up, competence. The tax practitioner must be competent in the subject matter on which they're providing advice. This requires the practitioner to have the necessary knowledge, skill, and experience to address the client's specific tax issues. This is why we generally have firms where if you don't really know what's going on in this particular situation, guess what? You ask the CPA or the accountant next to you and say, hey, you deal with farming a lot more than I do. I deal with manufacturing. Can you help me out with this person's tax return? So that's why we generally group together in a big firm. Next up, no conflicts of interest. The tax practitioner must not have any conflicts of interest that could compromise their ability to provide objective and unbiased advice. We see, and we'll continue to see, a lot of these items are very similar to audit. It's a very similar structure, right? You've got a client, you're doing work for them, no conflicts of interest, competence, good faith, reliance, all this stuff. Very similar to audit, and that's for a reason. It's not just by accident. I mean, you're doing a similar sort of engagement. Now, by adhering to these requirements, tax practitioners can ensure that their written advice or any advice, whether it's over the phone, email, whatever, complies with Circular 230 and provides clients with accurate and reliable guidance on tax matters. All right, very good. Next up, we're going to see Subpart B dealing with compliance and violations. Here, for internal controls, firms are required to have appropriate internal controls in place to ensure compliance with Circular 230. These controls help to ensure that all practitioners within the firm adhere to the ethical and professional standards outlined all throughout the Circular 230 we're dealing with here. So anything we see here, firms are required to have internal controls to make sure that everything we discuss throughout this lesson is going to be appropriately taken care of. Dissemination, education, and testing. Firms must disseminate the rules and regulations of Circular 230 to their practitioners, provide necessary education and training on these regulations, and if applicable, test their practitioners' understanding of the rules. This is going to be crucial for maintaining a high level of competence and ensuring compliance with the ethical and professional standards. Now we're moving on to wonderful Subpart C, also dealing with compliance and violations. Now we are dealing with sanctions for violations. Bringing down the banhammer, what happens if you break the rules? First off, Secretary of the Treasury's authority. The Secretary of the Treasury or their delegate has the authority to reprimand, suspend, or disbar practitioners from practicing before the IRS if they're found to have violated the provisions of Circular 230 or engaged in other misconduct. Now keep in mind, that did say practitioners from practicing before the IRS, not just CPAs. This is EAs, this is lawyers, actuaries, anyone who practices before the IRS. Willful noncompliance. If a practitioner is found to have willfully failed to fulfill their role as a tax professional, such as neglecting their duties or engaging in dishonest practices, they may face disciplinary actions, including suspension or disbarment from practicing before the IRS. And then we've got petition for reinstatement. Let's say you broke the rules, you got reprimanded, you dealt with the consequences. If a practitioner has been suspended or disbarred, they may petition for reinstatement after a specific period. Generally, the individual must wait for at least 5 years from the effective date of the suspension or disbarment before submitting a petition for reinstatement. The petition should demonstrate that the individual is fit to resume practice before the IRS and has complied with all applicable requirements and conditions. You're a law-abiding citizen again, you're doing the right thing, and we will let you back in. All right, here are various instances of incompetence and disreputable conduct in which you may be sanctioned. Now, all of these could be in a sim, multiple choice question, just various examples. It's not an exhaustive list, obviously. There are many more examples, but these are generally the most common examples you will see on the exam. First off, criminal convictions related to federal tax law, dishonesty, breach of trust, or any felony indicating unfitness to practice before the IRS. And keep it nice and broad. Maybe whatever your misdeed is not directly related to taxes, but if you have some sort of other misdeed, they could likely ban you from practicing before the IRS. Providing false or misleading information to the Department of the Treasury, its employees, or authorized tax tribunals. Makes sense. You don't want to do that. Engaging in prohibited solicitation of business as outlined, as we talk about here in Circular 230. Advertising how to get business, just breaking the rules of Circular 230 in that regard. Willfully failing to file a tax return. Like if you can't even do your own tax return, how can we expect you to do the tax returns of others? Evading or attempting to evade assessment or payment of federal tax. Counseling or assisting others in evading or attempting to evade federal tax, whether you do it or you try to get others to do it. Either way, not good. Shouldn't be doing that. Failing to timely remit funds received from clients for tax or other obligations owed to the U.S. government. The U.S. government wants their money, and if you slow that process down, oh boy, will they come down on you. Using threats, false accusations, or offering gifts to influence official action by any IRS employee. Not good. Do not want to be doing that. Being disbarred or suspended from practice as an attorney, CPA, public accountant, or actuary, or knowingly helping someone ineligible to practice before the IRS. Another breaking of the rules. Engaging in abusive behavior, making false accusations, or circulating malicious or libelous matters. Knowingly, recklessly, or through gross incompetence, providing false opinions on tax law questions. I mean, all of these pretty much really straightforward, not much room for debate here. Obviously, what you'll see, questions that will go through specific examples, maybe 5 sentences dealing with what this person did, and you'll have to identify that. But these are just the rules. You'll see that in practice as we run through questions. So failing to sign a tax return when required by law without reasonable cause or due to willful neglect. Unauthorized disclosure or use of tax returns or tax return information in violation of the IRC, court orders, or administrative law judge orders, willfully neglecting to file an e-return when required, willfully preparing or signing a tax return without a valid tax preparer ID, that PTIN, and lastly, willfully representing a taxpayer before the IRS without the proper authorization to do so. All of these pretty straightforward in terms of you doing something wrong. And what I will say for this, as I say for any sort of ethics or rules that you'll see in any exam, is try to get a vibe, try to get an idea of what they're going for. Are they generally pushing more toward conflicts of interest? So, for example, when we deal with audit, there are some instances where they are more concerned with conflicts of interest than anything else. In this case, what is the IRS, the IRC, Circular 230? What is their major concern? And I'm not going to sum that up for you. Your goal is to do that for yourself as you go through and you get an idea of all of these. And then especially as we go through multiple choice questions, as we go through sims, what are they going for here? What is their biggest caveat? What's their biggest concern? And yeah, I will give you a couple leads on that. It's no doing anything false. Obviously they're very concerned with you preparing tax returns with no consideration of audits or anything else, not trying to be a fraud here, getting the payments to the IRS on time. So those are some of the bigger points. But generally, again, are you going to memorize all of these? No, because a lot of this is common sense. It's just running through different various examples and practicing. Circular 230, very important for the exam for sure. So just the more examples you see, the better off you will be in assessing the examples they'll give you on the exam. Next up, petition for reinstatement. We talked about this a little bit, but Subpart D specifically deals with it and just goes into a little bit more details. So here, the waiting period, like we said, is generally about 5 years. Petition for reinstatement requirements, it must be in writing. It must include a detailed explanation of the facts and circumstances leading to the disciplinary action, the practitioner's subsequent conduct, like how you've been doing since then, and the reasons why the practitioner believes the reinstatement would be in the best interest of both the public and the tax administration. We're just kind of going through this quickly because we did deal with it and none of this is critically important. Good moral and professional character. The practitioner, or the petitioner rather, but the former practitioner must demonstrate that they currently possess the requisite moral and professional character to practice before the IRS. This may include evidence of rehabilitation, continuing education, and compliance with tax laws and regulations. And lastly, we've got a decision on that petition. The decision to grant or deny a petition for reinstatement lies within the discretion of the IRS. The IRS will consider various factors, such as the nature and severity of the prior misconduct, the petitioner's subsequent conduct, and the public interest in maintaining the integrity of the tax administration. Moving on to Subpart E. This is going to deal with general provisions, really just kind of a bunch of random points. And as we see, yeah, there are some overlap, but the overlap we see with these sections, it's still something you need to know for the exam, so it doesn't hurt to see it again. Just, again, kind of like a catch-all here. Sanctions. This section is going to outline possible sanctions. You're like, oh, we've dealt with this already. Yeah, but they like to really drill things home, make sure they beat them to death. So just deals with sanctions. Standards for professional conduct deals with that. This is not too important, just kind of an FYI that it is here. I'm just acknowledging that Subpart E exists. Procedures to ensure compliance deals with a little bit there, the right to a hearing. And then monetary penalties deals with that. So any sort of monetary penalties, you'll see them here. Again, not too critically important here, just more of an FYI.
Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.